G'day, I'm Jonathan Bayes with the September Investment Market Update. And the last 3 to 4 weeks after reporting season here in Australia saw a continuation of what we've seen for the better part of 2019, which is the economy softening up, both locally and globally, but markets continuing to grind back towards their highs. In China, we saw continued weakness in the economy, which is being threatened by the ongoing trade stoush with the United States. Hopefully the negotiations, which will fall in early October, might bear some fruit this time. There's some conciliatory remarks being made by both sides, and I think a recognition that we need to see this resolved or face global recession. But in the United States too, the manufacturing data for August really started to weaken off as well, and we're seeing new order flow dry up and inventory starting to build. So there's a real need in the United States, I think, and certainly for Mr. Trump and his re-election hopes, to resolve this trade issue in one way, shape or form. In Australia, despite the multiple levels of stimulus coming through from income tax cuts and interest rate cuts, the economy continues to stall. Only last week, we saw business conditions, according to NAB, at their worst level in the last 5 years. Business confidence and consumer confidence remaining pressured as well. So again, despite the stimulus coming through, conditions remain pressured. The construction industry here is wallowing around its lows. We're yet to see any sort of uptick in building approvals. So we're probably going to have to wait until early 2020 for that to come through. One of the major themes we've tried to incorporate into our portfolio construction, and notably the Australian equity component, is our anticipation of a big uptick in takeover activity in Australia in the coming 12 months. We've noticed recently that the bid by the Chinese dairy company China Mengyu for Bellamy's, the infant formula maker, here at a whopping 60% premium to its last traded price. And just would highlight the fact that there's many other Bellamy's, we think, out there in the Australian market that are facing short-term earnings difficulties, but offering really fantastic long-term earnings upside. And we think that with the weaker Australian dollar, again, the stimulus in the local economy coming through, and these really deeply discounted valuations in many businesses in the Australian market, that both corporate buyers and potentially financial sponsors, such as private equity players, are likely to jump on these opportunities in the coming 12 months. We think there's several stocks in our portfolio that are at risk of a takeover, and we're very hopeful that this theme will play out in a positive way for the portfolios in the coming 12 months. And this month we're pleased to have Kerry Craig offer his insights on the global economy.
Economic growth in the second quarter of this year in Australia was the weakest it's been since the global financial crisis. Underneath that weakness really was about the consumption. It fell down to a severely low level. However, when we look into the second half of the year, we expect to see some of that consumption rebound. Monetary policy acts with a lag, and those 50 basis points of interest rate cuts from the RBA will take time to feed into the economy. Similarly, the fiscal stimulus that we see come through in terms of the tax rebates will also add to a bit more discretionary spending by households. The question really is how much though? Households are highly levered in Australia, we know that from the housing market, and really for long run sustainability we need to see some of that debt be addressed and paid down over time. This means that a lot of that extra money that households have is likely to go towards paying down debt rather than being spent in stores. And so while we expect consumption to remain subdued, we do see that in combination with further rate cuts next year to support economic activity in Australia. We will also see a bit of a benefit of trade come through as well. As Chinese continues to stimulate its economy, we will see support for metal prices and iron ore prices, which will hopefully add a bit to the trade story in Australia. Really, the outlook is focused on fiscal spending in the long run though, and unfortunately we may not get that until the budget next year. Something investors are considering a lot is where to get income in this current environment. We've seen a spike in the stock of value of global bonds that have a negative yield. It's $16 trillion across both government bonds and corporate debt. Now that's unlikely to fade as we see central banks pursue this policy of a race to zero and negative interest rates being introduced in many markets such as Japan and the Eurozone. Effectively that brings down global government bond yields. The case is that we are likely to see further easing from central banks around the world in developed and emerging markets, and that means that bond yields are going to stay low. and income is going to be harder to come by. We do think there's scope to find income in corporate debt and other areas of the fixed income market, but we prefer to look at equities and non-liquid assets when we're thinking about how to get income in this environment, and the bond yields which are more likely to fall than rise in this environment.
So looking into next month, we're hopeful that we'll get a resolution to what's been almost 2 years of trade imbroglio between the Chinese and the United States. And on the local front, in the Aussie equity portfolio, we're hopeful we'll get some news through from IWF on a successful takeover for ANZ Wealth. Anyway, thanks for listening.